So you have some cash and you want to make your first investment. But it's confusing because there are so many stocks out there, conflicting advice, and panic in the headlines. As a 35-year-old self-made millionaire who's made hundreds of thousands of dollars in the stock market, let me just show you exactly how I would invest my first $10,000 or whatever amount you have. Starting with investment number 0, which most people skip, and that is cash and paying high interest debt. Now, it's not the sexiest thing in the world, but we need cash saved for both emergencies and short-term goals. Emergencies could be things like car repairs, unexpected medical expenses, or maybe you lose your job due to a recession. Now, we want this money to be liquid and accessible, so accounts like high yield savings accounts and money market funds are best in my opinion. In terms of how much you should have, we want to aim for at least 6 months worth of living expenses. So think about how much it costs for you to live each month, strip out all the luxuries, we want just the essentials, multiply that number by 6. Now, if you're self-employed or you work in a niche field, meaning it'll be a hard time for you to find a new job, we want to save 9 to 12 months worth of expenses. Now, the last thing we want to do before we make our first investment is pay off high interest debt. We're talking about things like credit cards or auto loans, really anything that's above 6% APR. So for example, credit cards have an average APR of about 25%. And just to give you a comparison, we know the stock market historically has returned about 7 or 8% after inflation. Sure, we can invest the money while keeping our credit card debt around, but our debt's going to accumulate much faster than the money we make in the stock market. All right, with those prerequisites out of the way, let's talk about the first investment I would make. Now, keep in mind, this is what I'm cool with investing in. You have to understand what you're comfortable with. And before you invest, you have to understand what you're investing in and the risks associated with the investment. All right, the very first investment I would make using 70% of my cash is in an ETF or mutual fund that tracks the US stock market. One of the more popular examples is an S&P 500 fund like Vanguard's VOO. Now, by investing in a fund that tracks the S&P 500 means that you're going to be investing your money across 500 of the largest companies here in the US. Now, let me give you a gaming analogy to explain what the S&P 500 is. So imagine a video game leaderboard. This is for a game called Valorant. You can see here the list of the top players currently in the leaderboard. And what's happening here is these players are constantly competing, going up and down this leaderboard, right? So you can think of the S&P 500 of a list of 500 of the top companies here in the US who are essentially just competing with each other. And the more money they make, the more successful they are, the higher up on the list they go, and the more money that we make as the investor. But we know that stocks don't always go up, so we can easily be going down. Companies can be performing worse and worse, and as a result, we could lose some money, temporarily at least. But don't worry, the benefits of investing in a fund like this vastly outweigh any of the drawbacks, which we'll talk about later. Now, in terms of performance, we can see the 1, 3, 5, 10, and all-time performance of this S&P 500 ETF. We see that it's 8% for the 1 year and then 12% for the 10 year. If we dig a bit deeper here, we can see that in the S&P 500, we have around 30% of it being information technology, so tech companies. We can see other sectors like healthcare, finance, industrial. We have all sorts of different sectors. And of course, you'd see companies like Apple, Microsoft, Meta, Berkshire Hathaway, Broadcom. But when it comes to ETFs and mutual funds, we have to understand that there are fees associated with them. They're not free to invest in. So for example, we have what's called an expense ratio. That's the fee. It's 0.03% for this particular fund. Now, these can go quite high for the funds that are more actively managed, since this is what's considered a passively managed fund. They're basically looking at the S&P 500 index, which is just a list of companies that changes every quarter. They're just going to go and copy that list. So that's why this fee is quite low. And just to give you a quick example of how much these fees will add up to, let's say we invest $10,000 upfront for 30 years, and we invest $5,000 each year after that, and we earn about 7% each year on average. With a 0.03% expense ratio fee, we're going to spend about $3,500 on fees, and we'll end with about $577,000. But if we bump this fee up to 1%, which on the surface seems pretty innocent, right? We're paying $100,000 in fees. So pay very, very close attention to the expense ratio. Okay, sounds good, but why don't we just invest in these top companies ourselves? Why don't we just go all in on Apple or Nvidia or Netflix? They're doing well, right? So this graphic here shows the top 10 companies in the S&P 500 by decade. So if we look back at 1990, we can see the top 10 companies on the S&P 500, IBM, Exxon, Shell, Walmart. We fast forward to the year 2000, we see less and less companies in common with the last decade. We fast forward all the way to 2024, and the list is almost unrecognizable. So the moral of this story is, sure, Apple, Nvidia, Microsoft might be crushing it now, but in 20 years, what's going to happen? We don't know. So it would be risky to go and invest manually in just these top companies because we don't know what's going to happen in the future, right? So think of the S&P 500 index as a self-cleansing list. It could care less about hype hype or the latest hot stocks. It cares about simple rules. Who's doing well and who's not doing well. No emotion, just pure data. That's how we like it. Another benefit of these funds is that they're super easy. A few clicks and boom, you're invested in the top 500 companies. Before you say you can go and pick your own stocks and beat the S&P 500, check this out. This is called the SPIVA report. Basically, they look at hundreds of investment funds that are actively managed and they compare it against the S&P 500. And we can see here that over a 15-year period, nearly 90% of these active funds, and remember, these funds are managed by professionals. These are full-time professionals analyzing stocks, choosing stocks, dumping stocks. 90% of them cannot outperform the S&P 500. So even if the professionals can outperform the S&P 500, do you really think you can? Probably not. And that's okay, because we can be lazy and beat the pros. Now, the problem with investing all of your money in the US stock market is that you're missing out on some amazing companies outside of the US, which is why I would invest 20% of my cash into the international stock markets. So the main way I get exposure to the international stock markets is with Vanguard's VXUX, and this is their total international stock ETF. And by investing in this ETF, you get access to over 8,600 different stocks around the world. Companies like Taiwan Semiconductor, Tencent, Alibaba, Nestle, whole gangs here. Now, in terms of performance, not as high as the S&P 500, but again, we don't really know what's going to happen in the future, and I'll talk about some more benefits of having this fund. And looking at fees here, it's at 0.05%, just a tad bit higher than the S&P fund we looked at previously, but still very low. And just a quick side note here, there is another fund called VT. This is Vanguard's Total World Stock ETF. This essentially combines the US market with the international ETF I talked about just previously. So with this one fund, you get about 60% US stocks and 40% international. So why am I investing in this fund? Well, it has most of the benefits of the previous fund. Super simple. You get diversification all around the world. And the reason why we want diversification is because we don't know what's going to happen. We don't know if the US is going to continue performing as well as it has. Will the political climate change in this country? Will we be taxing these companies more? We simply don't know what's going to happen. So if we don't know what's going to happen, wouldn't it make sense to get a little bit of everything? And again, this is what I'm comfortable with. So if you feel more comfortable investing 100% of your money into the US stock market, totally fine. If you want to do 50-50, whatever works for you, because the best portfolio at the end of the day is one that will allow you to sleep at night. Now, this next investment is not a stock, and if you invested early enough, you'd be a multi-millionaire by now. Before you freak out, just hear me out. I would invest 5 to 10% of my money into Bitcoin. Now, I'm not going to deep dive on how Bitcoin works in this video, but I'll put a card up here somewhere. I have a second channel where I do a complete deep dive and how to securely invest in Bitcoin. But in a nutshell, Bitcoin is essentially a decentralized peer-to-peer payment network. So imagine you have to send money to somebody. How do you do it now? Well, we have services like PayPal, Venmo, Zelle. You go out to dinner, someone pays for the bill, and you say, hey guys, can you Venmo me? Imagine that, but instead of depending on a trusted third party, there is this network of computers owned by really anybody who wants to participate, and they are what's facilitating these payments. It is remarkable. I highly recommend you learn more about it before you invest, obviously. And I truly believe if you have a strong understanding of Bitcoin, you will see its value. But again, it's not for everyone. Two ways that I invest in Bitcoin. The first way is through an ETF by VanEck called HODL, and I hold these ETFs in my retirement accounts like my Roth IRA, for example. This is so I can get exposure to Bitcoin, but also not pay taxes on any of the gains, assuming I take it out in retirement. The downside with ETF versions of Bitcoin is that you don't actually own the Bitcoin. One of the main philosophies behind Bitcoin and cryptocurrency is that you have actual ownership of the coin, and it's not being held by anybody else. Which brings me to the second way I invest in Bitcoin, and that is through a cryptocurrency exchange. So with an exchange, you can actually purchase Bitcoin and have custody of it, meaning no one else is going to hold it for you. And this is assuming that you purchase it from an exchange and then transfer from here into your own wallet. Now, in terms of performance, we can see here over the last 10 years, Bitcoin has increased over 20,000%, about 955% over the last 5 years and 50% in the last year. But before you get too excited, please understand this. Bitcoin is not for everyone. I understand it better than most people out there, and I'm comfortable with investing in it. Please do not go all in on Bitcoin. Instead, I want you to learn about it. Now, once you do learn about it though, then it's time to shift and understand the risks. Unlike the US dollar or stocks, Bitcoin is not really backed by anything. There is no government or company behind the scenes. Really just a community of people running computers all around the world. Although you could argue the same about gold and silver, but that's another video. Now, because of this, there really is nothing stopping Bitcoin from going to zero. On top of that, because Bitcoin really is just software running on computers all around the world, there are some security risks. Software has bugs and software can be exploited, so hackers could potentially exploit Bitcoin software, and that could result in the theft of your Bitcoin. Earlier, I mentioned how you can invest in Bitcoin via an ETF or self-custody. If you choose the self-custody option and you have poor security practices, somebody could trick you into sending them your Bitcoin. It happens all the time. Really, the last risk is going to be regulation. Although governments can't do anything to shut Bitcoin down, it's just something to keep in mind. So why invest in Bitcoin? Diversification, right? We talked about the US stock market, international stock markets. There really is nothing like Bitcoin, in my opinion. While it is similar to gold, there just are aspects of it that just aren't found anywhere else. Another reason why I invest in Bitcoin is because trust right now is at an all-time low. Trust in our government, trust in many of these large corporations. Since Bitcoin is decentralized in nature, it's not owned by a government or a company. It's owned by the community. In my opinion, as time goes on, these problems are only going to get worse. The last reason I invest in Bitcoin is because anyone can participate. And the technology behind Bitcoin sets a new precedence for the world. Because there are many people right now in the world that don't have access to a bank account. I mean, really think about that. Bank account is the foundation for our financials, right? But how can we get these people access to the most foundational building block of our finances? Well, technologies like Bitcoin are a good starting point, in my opinion. Now, this last investment is extremely important, especially if you're nearing retirement, and that's bonds. Imagine you let either the government or a company borrow some money in exchange for some interest and eventually getting your money back. That's bonds in a nutshell. The only bonds I'm invested in currently is the iShares Treasury bond. And I'm basically just treating this like a savings account. Now, earlier I talked about high yield savings or a money market fund. You can essentially treat this as a money market fund. That's how I'm treating it, at least. So in other words, I'm using this partially as an emergency fund. But as I get older, as I near retirement, I will be investing in Vanguard's Total Bond Market ETF, which mostly invests in US government bonds, about 70%. As you can see, performance hasn't been great, but really bonds aren't about getting the highest returns possible. It's really about stability, which we'll talk about shortly. And again, fees are very, very low, the exact same as the S&P 500 fund from earlier. And here's a really quick example of why bonds are important, at least as you get closer to retirement. We have two investors in this example. Investor one experiences a really sharp decline in the value of their portfolio just 2 years into their retirement. Now, because this person is retired, they're taking money out of their retirement accounts to fund their lifestyle. And what happens is, as the years go on, they actually run out of money because they had this real sharp decline in the first 2 years. But if we look at investor two over here, they experienced that same decline 10 years into retirement. And as you can see, their money doesn't run out. So yeah, you're not gonna make a whole lot of money by investing in bonds, but you're gonna minimize that sharp decline when the markets do tank. And the idea is that we're switching from growth to preservation. We're trying to preserve our wealth and make it last through retirement. So as I get older, as I approach retirement, I will slowly be buying into this specific fund. Now, speaking of the stock market crashing, I want you to watch this video so you can learn how to prepare and take advantage of the next recession.